In the fast-paced world of investing, there's a timeless debate that has seasoned pros and newcomers alike scratching their heads: growth stocks versus dividend stocks. It's a classic showdown. On one side, you have the high-flying, headline-grabbing giants like Tesla and Apple, promising explosive growth but often coming with a side of stomach-churning volatility. On the other side, you have the steady, reliable titans like Johnson & Johnson and PepsiCo, offering consistent dividend payments in a much smoother ride. But here's the million-dollar question: which one of these strategies is the superior path to building serious wealth, and which one builds it faster? Let's dive deep and find out. So, what exactly makes a stock a growth stock? Think of them as the sprinters of the stock market. These are companies that are expected to grow their earnings, revenue, and market share at a much faster clip than the overall market or their industry peers. They're often innovators, disruptors, and game changers. A perfect example is Tesla. Back in early 2020, you could snag a share for around $50. Fast forward to today, and that same share has skyrocketed past the $430 mark. That's not just growth, that's an explosion. This incredible surge isn't based on past performance alone. It reflects a massive wave of investor optimism about the future of electric vehicles, autonomous driving, and renewable energy. Investors are betting big that Tesla will continue to dominate and innovate for years to come. Another textbook example of a growth stock is Apple. Even though it's one of the largest companies on the planet, it continues to find new ways to grow. From the iPhone to the Mac, the Apple Watch to its booming services division, Apple has mastered the art of consistent innovation and expanding its ecosystem. This relentless drive has led to truly substantial capital gains for investors who got in and held on. The core idea with growth stocks is that instead of paying out profits to shareholders as dividends, these companies reinvest that money back into the business, funding research and development, expanding into new markets, or acquiring other companies, all in the pursuit of even faster growth. You're essentially sacrificing immediate income for the potential of a much bigger payday down the line when you sell your shares at a higher price. It's a high-risk, high-reward game that can be incredibly lucrative if you pick the right winners. Now, let's switch gears and talk about the other side of the coin: dividend stocks. If growth stocks are the sprinters, think of dividend stocks as the marathon runners of the investing world. These are typically large, well-established companies with a long history of stable earnings and a strong competitive advantage, what investors like Warren Buffett call a moat. Instead of reinvesting all their profits back into the business, they share a portion of those profits directly with their shareholders in the form of regular payments called dividends. A prime example is Johnson & Johnson, a true stalwart in the healthcare sector. Looking back to early 2020, its stock price was around $160. Today, it's trading over $185. While that's not the explosive growth of Tesla, it's a steady, reliable climb. But that's only part of the story. Throughout that time, Johnson & Johnson has also been paying a consistent, reliable dividend to its shareholders, providing a steady stream of income regardless of the stock market's daily ups and downs. Another fan favorite among income-focused investors is PepsiCo. You know their brands: Pepsi, Lay's, Gatorade, Quaker Oats. They're household names found in pantries all over the world. This incredibly strong and diverse brand portfolio gives them predictable cash flow and allows them to deliver consistent dividends year after year, like clockwork. For many investors, especially those nearing or in retirement, this predictable income stream is incredibly attractive. It can be used to cover living expenses or, for those still in their wealth-building years, reinvested to buy more shares, creating a powerful compounding effect. This is known as a dividend reinvestment plan, or DRIP, and it can significantly accelerate your wealth building over the long term. With dividend stocks, the focus shifts from purely chasing rapid price appreciation to creating a reliable, growing stream of passive income. So, how do these two strategies stack up when you put them head-to-head? Let's compare the performance of our two examples, Tesla and Johnson & Johnson, over the past 5 years. When you look at Tesla's stock chart, it looks like a mountain range full of dramatic peaks and sharp valleys. The volatility is undeniable. There have been periods of breathtaking gains followed by gut-wrenching corrections. However, for investors who could stomach the ride, the overall returns have been absolutely phenomenal. An investment in Tesla 5 years ago would have grown exponentially, far outpacing the broader market. In stark contrast, Johnson & Johnson's chart is more like a gentle, rolling hill. The growth has been steady and consistent, with far less volatility. You're not likely to lose sleep at night worrying about a 20% drop in a single week. This comparison perfectly illustrates the fundamental trade-off in investing. The potential for higher returns almost always comes with higher risk and greater volatility. The thrill of rapid growth versus the comfort of slow and steady stability. This brings us back to our central question: which one actually builds wealth faster? To answer this, we can't just look at the stock price. We need to look at the total return, which for a dividend stock includes both the price appreciation and the dividends paid out. Let's imagine two investors. Investor A put their money in Tesla, and Investor B put their money in Johnson & Johnson, reinvesting all the dividends. While Tesla's explosive growth has certainly created immense wealth in a very short period for Investor A, making it the clear winner in a short-term sprint, the picture can look different over longer time horizons. For Investor B, Johnson & Johnson's consistent dividends, when reinvested, start to compound. They buy more shares, which then generate more dividends, which buy even more shares. It's a snowball effect that builds wealth reliably and predictably over time. Ultimately, the faster path depends entirely on your personal investment goals, your time horizon, and, most importantly, your tolerance for risk. Are you aiming for a home run, knowing you might strike out? Or are you content with hitting singles and doubles consistently to win the game over the long haul? So, what's the final verdict? As with most things in finance, there's no single right answer. The truth is, both growth stocks and dividend stocks have clear and compelling merits. Growth stocks, with their potential for massive capital appreciation, can be a powerful engine for wealth creation, especially for younger investors with a long time horizon who can afford to take on more risk. Dividend stocks, on the other hand, provide a foundation of stability and a reliable income stream, which can be invaluable for preserving capital and generating cash flow, particularly for those closer to retirement. But here's a thought: why choose one when you can have both? Perhaps the most effective strategy for the average investor is to build a well-balanced, diversified portfolio that includes a healthy mix of both. By blending the high-growth potential of companies like Tesla and Apple with the stability and income of stalwarts like Johnson & Johnson and PepsiCo, you can create a harmonious portfolio. You get the best of both worlds: the engine of growth to drive your portfolio forward and the anchor of stability to help you sleep well at night. This balanced approach can help you navigate different market cycles and achieve a robust blend of both growth and income over the long run. If you found this breakdown of growth versus dividend stocks helpful, do me a favor and hit that like button and subscribe to the channel for more deep dives into investment strategies. And don't forget to click that notification bell so you never miss a new video. Now I want to hear from you. Drop a comment below and let me know your preference. Are you team growth stock, team dividend stock, or do you believe in the power of a balanced mix? Thanks for watching, and I'll see you in the next video.